One of the reasons that I think this is a really important conversation for today is because Gary Keller shared some stats at MegaCamp a couple months ago. And 39% of homeowners currently own their homes outright. So almost 40%, and those homeowners have options. They have options of selling, and they also have options of doing owner finance. There's also another 31% that have more than 50% equity. And so there's also an option for that pool of people to potentially sell their homes owner finance. So you have almost 70% of the current homeowners that seller financing could be an option if they were knowledgeable, if they were educated, and they knew what kind of benefits there would be. So I want to first talk about all the different ways you call owner financing, seller carry, owner carry. In the MLS, it specifically says owner will carry. Like that's the box that you check if you want to specify that this home is for sale owner finance. So these are all synonyms, they all mean the same thing. It basically means that the seller is going to be the lender, and the seller is going to hold the loan for the buyer. So let's first talk about what does this look like in a structure. Sorry, the formatting got messed up. Sally, seller, she either owns her home outright or she typically has high equity. Those are what you're looking for in terms of like the typical owner finance seller. And usually they're interested in cash flow. So instead of saying, I need all the equity out of my house today, one of the conversation topics that you can have with them is, well, what are you going to do? Let's say you cash out of this house, you get $200,000 at closing. What are you going to do with the money? And if they come back to you and say, well, I'm going to invest it in something. And you're like, well, how about you lock in your investment and your return right now? And that's what you can do. Let's say the seller does 5% interest, they can get a 5%. They can get 5% return on that money for a long period of time. So they don't have to take the time after closing to go find another place to invest it. Now the buyer buys it like any normal transaction, except the seller becomes the lender. So actually there's a lot of advantages to that we're going to talk about today, including lower fees, a little bit less time to close, things like that. But the seller is selling to the buyer and they're also lending to the buyer. So what's one thing that is typical, but it doesn't happen all the time, but it's typical, is that there's a loan servicer in the middle. So if your seller comes to you and says, well, I don't want to do seller financing because I don't want to, have to deal with the payments and the taxes and the insurance, you can assure them that that is not their job. And personally, I like to leave it up to the professionals. You can have a third-party loan servicing company. It costs between $20 and $50 a month, and they are going to handle the tax escrows, the insurance escrows, the tax adjustment, all the adjustment letters. They are going to take the money in. If the borrower pays more, let's say their payment is $995, and they decide to pay $1,000 every month. Well, that extra $5 affects their amortization schedule. So that third-party loan servicer is going to be the one to track the actual amortization and the true payoff. So that if the buyer is going to sell the house and the title company says, I need a payoff statement, that third-party loan servicer is going to be the one that has that final loan payoff statement. Now that loan servicing company is going to collect the money from the buyer, and then they're going to divvy up all the taxes and insurance, put those in escrows, and then the seller just gets ACH or direct deposited their portion of the payment. So this can be a very hands-off process for the seller. The seller just, like when I have my notes, my third-party loan servicer processes all the payments, and they just ACH me my portion of the payment every single month. Come on in. I want to give you some options for third-party loan servicers. The one that I use is Allied because they're one of the least expensive. but I also feel like you get what you pay for. Their portal's not very good, I'll admit it. FCI is a little bit more expensive per month, probably closer to that $25, $30. Allied's $18.50 a month per loan. Evergreen Loan Servicing is another one that is referred by the KW Wealth Mastermind. And Open Door Loan Servicing is one that I used to use. And there weren't any issues, I just wanted to go to a different one.
Is that Open Door, or is it?
It's different, it's a totally different company than like Open Door that buys homes. I do wanna say that it is not required to use a third-party loan servicer. But if you aren't going to use one, like you can select, and you'll see on the, when we talk about the contract, you can select that there's gonna be no escrows. And that the borrower is just gonna pay their own insurance and taxes. That is an option. And with that option, it would be a lot easier for the buyer to make the direct payments to the seller. But the seller still needs to be keeping track of the amortization. So if they're comfortable with that, you don't have to use a third-party loan servicer. But if your seller says, I don't wanna deal with any of that stuff in the middle, then this is the best option for them. Typically, if you are on the seller's side, you want the borrower to pay this third-party loan servicing fee, that $20 to $50 a month. If you represent the seller, you want the buyer to pay for it. If you represent the buyer, you want to try to get the seller to pay for it. So it's negotiable who pays this $20 to $50 a month fee. Yeah.
So then if you're buying it, say from them directly, it's negotiable. If they don't want that whole service, I mean, I know they could, but if you're buying it to have more peace of mind, you would really want that, right? So you'd probably say, you take it over. If they're like, no, I'll do it myself, whereas like you want it tracked.
If you're representing the buyer and the seller says, no, I don't want that third-party loan servicer, then I, as a buyer, would demand that, oh, I'm gonna pay my own taxes, I'm gonna pay my own insurance. Because I don't want the seller managing that.
Yeah.
I would rather have a professional company managing that. Does that make sense? Okay, so let's talk about the contract. So, in the 1 to 4 family, the financing section, I think 99.9% of the time, we always select third-party financing addendum. That's okay. We usually select third-party financing, or if we cash offer, we don't select this any at all. But it does give you the option to select seller financing addendum. And what I love about this whole process is these are TREC promulgated forms. You're not using some attorney form, you're not writing special things in the contract, these are all promulgated forms that you're using. And so, paragraph 3 of the 1 to 4 family, you would be selecting seller financing addendum instead of third-party financing addendum. Oh, that's a good theme song. So let's talk about the seller financing addendum. This is TREC form 26-8, it's available at all major retailers, wherever you get your forms from, right? I've downloaded a blank copy from TREC's website, and there's also a blank copy if you visit the resource folder here, and you're gonna get access to all that at the end. But here's the things it talks about. Whether the buyer is gonna go through underwriting, and we're gonna go through each of these sections. What's gonna be the loan terms, the payment terms of the loan? What are the rules regarding the resale? So can the buyer just sell it and not tell the lender, the seller? Insurance, taxes, escrows, and then third-party loan servicing, if it's gonna be in place or not, and who's gonna pay for it. So let's talk about underwriting. The seller is the lender, so they get to choose what level of underwriting they do on the borrower, the buyer. They could choose to just run a credit check. I talked to one agent this morning who said, you know, it's a small seller finance loan and all they're really interested is just making sure that the borrower can afford the payment. They just want bank statements. Maybe the person just wants a credit score. On mine was a $200,000 loan, so I actually ran her through an underwriting company. And this was my contract, my third party, my seller financing addendum, sorry. And so I literally put, this is all items required by Owner Finance Network Processing Services at phone number this. So I didn't wanna have to list it out, it's like, here's whatever this company needs is what the borrower needs to provide. Now, again, this is completely flexible. Johnny, can you give an example? What kind of documentation do you use for your borrowers?
Yeah, I'm probably not the guy to ask. The more money they put down, the less I ask. So, I mean, I ask them their incomes, where they work, how long they've been there, and if I can get 15, 20% down, then I'm usually good.
Okay, so everybody's thresholds are different. Johnny gave an example that if they're putting 15 to 20% down, and they have a work history, then that's about it, that's all he checks into. For me, this was my first one in a few years, and I was like, I really wanna go through the whole process. One thing I will say, just like when in a normal transaction, the lender charges fees to the borrower. So all of those underwriting fees get charged back to the borrower. So this company costs $1,100 to go through the full check. And I would say that prices range from around $800 to $1,500. That would be about how much you would expect to pay for a full underwriting, a third-party company to do that underwriting for you. But you get to charge it back to the borrower. So that's just something to know up front, because a lot of times in seller financing, they may ask you, so what are the expected fees? And you may just wanna just say, $1,500 or less for underwriting. Or you could give them an estimate. But Owner Finance Network is based out of Garland. They offer it, and then another company that offers it is called Call the Underwriter. Call the Underwriter. So those are two options for vetting, having a third party vetting the borrower. Now, it's again not required. You can choose what level of vetting you want to do.
Because if they don't go all the way forward, then you're on the hook for that.
Yeah, so actually I ended up using Call the Underwriter, and they did make me pay for it, and then I was gonna get reimbursed at closing. So yes, if they would have canceled the contract, I probably would have requested repayment from the borrower to try to recap that.
That answers my question.
Okay,
Is that in your contract somewhere?
it isn't, but I mean, if they cancel outside of option period, you get to keep their earnest money anyway. So you could potentially wait to do this credit check till their option period was over. Cause there's still protections in there, like if they don't qualify, then they get, if they just wanna terminate, right, then you get to keep their earnest money.
What if they don't qualify? I'm sorry.
Well, if they don't qualify, then you have the option to cancel and say no, like reject them,
But you're
basically.
still out of the
Yeah.
1,100, 1,500.
Potentially, yeah. Did you have a question?
Yeah, I was just gonna say, from the standpoint of, ultimately the seller makes the call as to whether they qualify. Now, there are some requirements, if I'm not mistaken, that if you do more than 3 loans a year or something like that, then you really should follow these guidelines. But typically, if the seller says, hey, the reason they're wanting owner financing is because they're, not, their income's not quite there, but they, have other sideline jobs or whatever, then you can kind of make those decisions.
Yeah, and that's a great point. We'll talk about that in a few slides. Like the typical seller financing, well, there's different demographics. There's the people that can't qualify for the traditional lending. And you're in that bucket, you're not gonna get the 700 credit scores and the perfect tax returns. Like you're dealing with somebody who can't qualify. And so that's, maybe you adjust the down payment higher. Maybe you add an extra half point of interest. There's different ways you could protect yourself.
And then you
Or-
have the IT people that don't report everything.
Mhm.
Hey,
Yep, yep.
In those underwriter costs are include the credit check report or not?
I believe they do the credit check, yeah.
What is included in that amount,
Mhm.
the fee?
Like the whole 1,500,
Uh-huh.
yeah, they're doing a whole package.
So you listed yours, say the buyer came unrepresented. In this instance, would you have somebody represent them or kind of let them do it yourself? And I guess to get to them being able to be advised on the whole, or you trying to do intermediary? I don't know if you own it, if you can do that.
Yeah,
But to make sure they have the inspection or know that they have the option, so I guess if somebody came unrepresented, how would you handle that to protect both sides?
you know, the question was if somebody came unrepresented, would it be better if they had a buyer's agent kind of thing?
To
Like,
tell them about, you can get an inspection and this is option, would like,
you have that option. Not all owner finance homes are necessarily gonna be on the MLS even.
Right.
Johnny, maybe you wanna speak to like, some
Very
of his
few.
are just sold by word of mouth.
yeah.
And so in that case, there usually probably isn't a buyer's agent. It's just working, the buyer and seller are working together.
Hmm.
And so if you were listing a property,
Or even, yeah, I only said listed because we're all agents, but if I owned it, would you give them some type of advice on, hey, you wanna do an inspection, this is the option, this is what option period is?
yeah, that would, without giving them legal advice, you could talk to them about the process of buying a home, absolutely.
Okay.
And one of the reasons why the third party is kind of nice is because they kind of work with the borrower. And so it's like, you're not the one collecting their social security numbers and tax returns, like they're working with a professional company. And so it kind of helps create that unbiased third party, as well as the title company. And so usually, we'll talk about this, the title company attorneys are gonna probably be the ones to draw up the promissory note, the note for the seller. And so that the title company can also act as that unbiased third party if they have questions. Okay, so the next section of the seller finance addendum is where you put in the payment terms. And so this is just an example. Promissory note was in the amount of $190 at 10% interest. You have a payment, a beginning date, and a term, 360 months. Now, just like in a normal lending transaction, let's say closing was October 15th. At closing, they'll get charged prorated interest for October, but the first payment wouldn't be until December 1st. Because interest is paid in arrears. And so you just plug in, you can use a loan calculator, which I'll give you at the end, we'll talk about today. But you plug in the terms, all you agreed upon, basically the payment and the lane.
And you could put a balloon in there, you know, if you're working with an older client maybe, and they say, man, 30 years, I mean, well, my kids get all this, you can put balloons in 7 years, 10 years, something like that, to where, they do collect all that interest, but then they gotta go refinance at some point in time and pay them off.
Yep, that's a great point. The balloon would work if the seller said, no, 30 years is too long for me. So, okay, we'll give you payments for 10 years.
And then even in the contract, you could put in an option to extend for like a fee, right? Potentially. Like if it was supposed to be paid in 5 years, there could be an option to extend to 6 or 7, but you have to charge.
Yeah, so the question is if you could put in an optional extension, and the attorneys will write it up however you want. So it's really a blank slate. So if there was a balloon at 5 years and you say, I want an optional extension if I pay X amount, if I pay 1 point, I can get another 2 years. It's an open chalkboard of negotiating possibilities.
And, as a seller, you're probably, if your seller's wanting that money, you just say, look, address it when it comes up. If you're liking the money and you're healthy and everything's good, then you can kind of just extend this thing on out, or, redo the note at a higher interest rate if rates go up or something. So,
Okay, so not necessarily put it in there, just
I
year
would-
5 rolls around and they're like,
As
Hey,
an
we-
owner or a seller, I wouldn't put it in there up front. You know, if I was already demanding a bullet, because there's a reason I'm demanding the bullet.
And that brings up another good point. The lender, there's always, even after the loan's in place, it could be renegotiated. There could be a modification, there could be other terms, so like Johnny mentioned, if you get to, if it's a 5-year balloon, you get to like 4.5 years and the seller's like, you know what, I could take this payment for another 3 or 4 more years, then you just have the attorneys write it up and it modifies the loan.
and if you did the modification and we've had appreciation, would you probably, if you're recalculating it, say we agreed at 200,000, but 5 years comes and it's worth 250 and they want to extend with you, would you recalculate it at the new, I guess, market value, or just keep
Well, I mean,
it?
the market value, the person still owns the property, the
Okay.
one that bought it, so I mean,
Okay.
they're just in a better position. Your lender's not gonna get more money out of it because the property's appreciating.
No, well, you as the owner, if they wanted to up it in 5 years, if they wanted to
Oh.
extend, you only extend,
I mean, you can do anything, I mean, if you said, gosh, you know, this 220 property is now worth 400, mind loaning me a little more? Well, if, you know, the owner's got the money, they could always do that, but, and you still use the property's, security, but I don't think you're gonna run into that a whole lot. You know, it's, the people like the payments coming in, and now their loan's even more secure because now the property's worth 400. But, you'll always hear people say the best thing you wanna see is you sell somebody a property and they're out working on it immediately and making improvements, painting, doing a new fence and everything, all of a sudden your collateral is worth more.
okay.
So, I think correct me if I'm wrong, but what I'm hearing, you're asking it, as a seller, can you renegotiate price when you redo the note? Is that what you're asking?
Yeah, if you, would you, so you're 10% at 200,000, 5 years comes, they can't get traditional financing, would you say, okay, well, let's do 10%, but now the house is worth 250, can you, or would you, or can you not? When you redo this new terms, do the 10% based off of that?
It sounds like it's almost like a little bit more like a refinance, like you're going into a higher, the seller would have to give the borrower more money if the loan amount was going to increase.
So the question is, but I think you have sold the property, that buyer owns the property now, you are just a lender, so you can't go, the property's worth more now, I need to get some of that extra gravy back.
I think that's what I was saying, I said you can't do
If that's
that.
what you're saying.
Gotcha.
Now,
Yeah,
you-
no, I was asking.
You could go and say, well, I was charging you, let's say you did it back, you charged 5%, and now rates are 8%, you can come back and say, well, I'll do 12% if you wanna do it.
Okay.
Right.
So the interest rate could change in the length, but not the price.
Yeah, so you've actually.
Which is fine, but I just
You've actually
wondered.
deeded the property to them and you're now
Gotcha.
vendors living.
True that, okay.
Okay, so let's move on. The next section talks about, does the buyer have to give notice to the seller when or if they sell a property? And so you can select either consent is not required, they don't have to tell the seller, or the consent's required. B, the second option, gives the seller more protection. And this is similar to the due on sale clause that's in a traditional mortgage. But you have to go back, you have to say that, like, just because it says that they may call the note due, if they find out the property's been transferred, they don't have to call the note due. So this just gives the seller, the lender, the option and more protections. So paragraph D, 1B is much better, and I would say is much more common.
Can you
Yes,
change that lease for a period of longer than 3 years? Can you change that, like, I guess you could have a lawyer write it up, cause I remember I went to that wealth class with Ryan, right? He said that he sold the house under financing, but then the guy couldn't pay for it, so he got a leasing in there, which he didn't need, or didn't want, but it worked out for him, so I didn't know if it was like,
I'm sure if that was what you negotiated, you could have an attorney scratch that. If both people agreed, you could scratch that out and line it out to a different number of years. That's just the basic protection. Okay, next, lender getting named on the insurance. Can't really think of a reason why you wouldn't want the lender named on the insurance, so this one's pretty much always gonna be shall. That way, if the house burns down, if there's a claim, anything like that, the lender is going to be kind of in the loop. The check's gonna get made out to the homeowner and the lender, so you're gonna know about any major damage done to the house. So this is pretty much always gonna be shall. Shall obtain insurance, naming seller as a mortgagee, as a loss payee. Okay, and then the second section of that talks about the insurance and tax escrows. So this is where you're gonna select whether, here at the bottom, escrows are required or escrows are not required. And so you get to choose. The seller, it's choice, and usually that the seller is going to be the one to say like, I want escrows, I require escrows, or no, I don't require escrows. So it's usually the seller's choice. The buyer can always make a suggestion, but typically the lender's choice. And then if there are escrows required, and like Johnny, let's go back to, in a typical loan, if you put 20% down, the banks don't usually need escrows either. They don't require them. But in the seller financing world, everything's negotiable, right? If the seller, the lender wants it, then they can require escrows. If they trust the buyer to pay the insurance, pay the taxes every year, they don't have to require it. Now this down here, it says that you check buyer or seller will pay the cost of the escrow service. And so this is where, for example, I was the seller, I was the lender, and I wanted the buyer to pay that third-party loan servicing fee. Now, if I was representing the buyer, I would want the seller to pay for it. So it just, whoever's side you're on, you want the other party to pay for it, ideally. But in typical seller finance transactions, I would say it gets passed on to the buyer. Yes?
What happens if the buyer do not pay for the taxes, are delinquent in the taxes? What are the protections for the seller in that
So
situation?
the question was, if the borrower doesn't pay the taxes, what are the protections? Well, if you have a third-party loan servicer, they're gonna call you up. And they're gonna say, we don't have enough money in escrow, we need to pay taxes, let's talk about how we're gonna handle this. Whether they're gonna pay it, you would get notified by that third-party loan servicer. If you do not have a third-party loan servicer, it is up to you to go and look at the tax record and say to see whether they paid or not. So there is some responsibility on the seller if you don't have a third party to check to make sure that they pay taxes. Johnny, have you ever had one where they didn't pay the taxes?
No.
Nope.
I did have one time though, what you're talking about on that other part, where they did a contract for deed to someone else, and then they stopped paying, so they weren't collecting the money. It's the only time I've ever had to go to an attorney, because the attorney said, this is muddied up now. Those people do have some interest in that property, and so end up working out a deal to foreclose on the guy that I sold it to, which cleared the other deal out, but cost a little more.
Yeah.
So you have the right to foreclose if they don't pay the taxes.
Kind of works like a
Yep.
traditional.
Now, your deed of trust will read the.
But you need to hire a lawyer and.
Yeah, but that's why you try and get as much
Yeah.
down as you can.
Well, and with taxes, if I'm not mistaken, there's an option of, you could pay the taxes and then you add it to their loan balance. So that becomes part of their balance payable to you. So if you forked over $6,000 for property taxes because they didn't pay it and they were 6 months late, you just add it to their balance. And that would be something the loan servicer would be able to keep track of really easily, their legal balance. And if you didn't have that loan servicer, you'd have to keep track of that.
So if you want to minimize the risk for you, it's better to require to have an escrow. Because in that way, you don't have that risk at all.
Yes, I prefer to have the escrow. Johnny would give you a different answer, right? Everybody has different criteria,
It's your tolerance to risk.
yes.
Yeah,
Well,
we
yes.
watch it pretty close, we keep a
Mhm.
book on every property, we know when their, insurance expires and everything, we just watch it.
Yep.
And of course, if you're listed in there, and if they haven't renewed their insurance, the insurance company's gonna send you something that they're being canceled because you're not paid. I do require them to pay a year's upfront worth of insurance. And so, and my company's listed in there as the lien holder.
So it's not impossible to do it without a third-party loan servicer, it just takes some tracking.
Well, the nice thing about having them escrow is that if they're having problems month one, you're not finding out month 12.
Right,
So month one, your third-party loan servicer is already on them, like, hey, you're short or you're late, we can start taking action.
yeah, that's a great point that I didn't mention on the third-party loan servicer side, like if the borrower starts becoming late, they're gonna be the ones calling them and saying, hey, your payment's due, hey, your payment's due, where's the money? You know, that service falls onto them. And you kind of realize, like, as soon as you don't get that payment, you're like, oh, I should've gotten my ACH this month and I haven't done it, I haven't seen it. And then you could go back to your portal and see that they missed a payment.
How many payments will you allow them to miss?
So, in Texas, I mean, there's pretty lender-friendly foreclosure rules. So you could technically start the foreclosure process very early in the you know, if they miss
You
a payment.
certainly want to get their attention right away.
Yes,
And send
yeah.
something out to them.
but I do think like there is a little bit of cost to starting that process, you know, if you engage the attorney, if you send the letters, but that could be the thing to kick them in the butt to get paying again. But sometimes, like the loan servicer would probably start with a phone call and get the story. Oh, my dog died, my car broke down, I'll pay it, I'm gonna pay it next week, that kind of thing.
You might mention it later, but for this exact process, being able to use a check form, I thought for seller, finance, or owner carrier, they have to own it 100%, the free and clear, right?
So the question is, do they have to own it 100% free and clear? The answer is no. They could do what's called a wrap mortgage, where let's say they have a $50,000 lien on the home from when they bought it 10 years ago, and then they could do the big owner finance sale. Now, that's outside of the scope of this class, but
Okay.
you would work with an attorney that was familiar with creative financing and wrap mortgages.
So it would be different than this one, because this is what you're teaching as if it was owned 100% free and clear,
And I'll use the example, because I think I have it right in here.
because I want to know both. Because I know they're different, but I didn't know
Yeah,
if the way
I
it
took it out.
goes.
So this particular house that I sold just a couple months ago had a wrap mortgage.
Oh.
And so I'm the homeowner, and my underlying loan is $350 a month. It is set up on auto pay from my bank account. So that loan's on auto pay. So I did not have the third-party loan servicer handle that loan. And it's literally like $45,000 balance. So it's on auto pay from my account, just comes out every month. The third-party loan servicer managed the big loan. And one of the reasons why I like to manage the small loan is because I know it's gonna get paid regardless. So even if this borrower stops paying, that $350 is still coming out of my bank account every single month. So it is capable, it's easier if, like, I am the lien holder on the first one and I'm the lender on the second one. It's easier if that person is the same person.
Yeah, I knew they're different, but yeah, I want to know how to handle both as a licensed agent on a check form if possible, or with returning.
So the way I did it with this particular contract was in special provisions of the 1 to 4 family, I just put underlying lien will remain in place.
Okay.
Now, at closing was when the borrower signed all of the documents, there was probably like 12 pages of disclosures that the attorneys drew up that also disclosed and told everything about the underlying lien. So that all happened at closing, and I didn't draw up any of those documents, they were all done by the attorney. Okay, so we're gonna go back and talk a little bit more about vetting the borrower, because the main objective is that the borrower can afford the payment. They can afford the payment, they can afford the down payment. We talked about the third party, what's called an RMLO, Residential Mortgage Loan Officer, I'm pretty sure. Call the underwriter, Owner Finance Network, companies like that. But let's talk about when you're selling owner finance and you are selling to what could be called a penalty box buyer. So this is somebody that can't qualify for traditional lending. This is the kind of scenario where the property has, it's up for, 10% interest because they can't get the 6 to 7% conventional loan today. And what we typically see with the penalty box buyers are that they are gig employees. So they just work 1099 jobs, they might drive for Uber, they might, be a contractor, handyman here and there, they might mow the lawn this week. They're potentially self-employed, ITIN, or foreign nationals. And so, like I said, with this kind of buyer, you're not gonna see the 700 credit score, perfect tax return kind of demographic. You're gonna see the person who bought the house that I showed this samples from, she runs a catering company and she gets paid a lot in cash and she doesn't report a lot of that cash on her tax returns. So the agent, and there's actually agents out there that specialize in owner finance buyers. The agent told me she will probably never be able to refinance because of how little she puts on her actual tax return. Now, we went through the vetting process, I used Call the Underwriter, and Call the Underwriter gave her a thumbs up, and so I didn't even look into it any further, I said I'm giving her a thumbs up. Now, if they would've given her a thumbs down, I probably would've looked into it more to say, should I approve her based on my criteria? Like, what's their criteria, what's my criteria? That's where you could have decision making. They gave her a thumbs up, so I said, okay, we're moving forward.
Do you find that most of these do have the 10 to 20% to put down?
Yes, they do. And that's one of the ways, because they stuff cash under the mattress, they have lack of trust in banks sometimes. So the 10 to 20%, 20% is ideal, but 10% is what I would say is the minimum.
Yeah, I have somebody right now that the husband makes like 48K, but he does side projects, building stuff, and then the wife does shirt designs, and they've been doing that, but the normal lender can't qualify all that other stuff, so their buy box is small, but they have $25,000 in savings, and so we're kind of working through that right now. Where they're renting, we're gonna try to actually approach the owner about doing some type of seller finance.
Good.
In that case, they are cash only, managed cash, how do you handle the cash for the down payment and the title company?
The question is, how do you handle cash if they wanna bring real cash? I would let the title company handle that.
We had one years ago when, you could still buy the $75,000 home. She was a hairdresser, and she got her money in the bank, she wanted $75,000, well, how are you gonna do it? I am not kidding you, she showed up with $75,000 wrapped in foil, she had them in her refrigerator.
Oh my gosh.
So there we are, the title company, everybody was helping to count all this cash. She brought it.
Yeah, you better hope that title company has a
They
money
did
counter.
not, we were all
Oh, no.
counting.
But it's possible.
It is
It is
possible, and
possible.
actually, so I just had a colleague from KW Wealth who's up in Knoxville, and he just had clients, he's selling a listing on finance, he literally just had the buyers bring the money to his office and drop it off, and he's like, no, like, we need to take this to the title company, let them verify it, everything like that, so.
So the title is gonna take the cash and then they are gonna transfer you a real bank transfer.
That's,
Yeah?
that's how I would,
You take
For
Leo?
sure.
I don't want to deal with cash.
yeah, I don't wanna,
They'll deposit.
Yeah. yeah, they'll deposit. Johnny, do you have any comments?
The craziest story I've ever had, it was the holidays, and I ran into this group of people buying houses, and I sold 3 houses in about 3 weeks, for about $750,000 worth of houses. The first one was all $100 bills, second one was all $100 bills, third one was all $100 bills. And brought their attorney, did the deed, she did the title work, money just went to there, they gave me my cash and commissions, and then I had to call Beverly, who was the office, the CMA, and just say, Beverly, I got good news and bad news. I don't have any paperwork, and I got a bunch of cash. She said, go back and get a note from them saying that you were just a representative working on this transition with them or something, we had to word that. But, I mean, money still spends, it's just, usually if you press them, they'll go get a cashier's check. I've had people that I said, what, if you're gonna do this, go, take $5,000 a week and go get a cashier's check for it, and get a plan ahead of time if you're working with it. But it's not really good to have that much cash.
Yeah, yeah,
I took a picture of one of them, I said, you might.
So in these cash transactions, banks or other lenders usually have to source the money to make sure it's not tainted. As seller financing, is there any risk there if you're a seller financer, like, well, if this is all drug money, because I can't tell? Do you have any responsibility, or it's green, it spends, but
that's why I would rather the transaction run through title, like, they,
the title has to do something, why shouldn't they have to report a cash deposit with somebody's name on it?
potentially, I mean, you're checking, like, with owner finance, it's, that just may be one of the but that's why I want it all to be documented, right? It's all documented, if the money's bad, like, I wanted to show that they brought cash to the transaction, title processed it, I was given my money based on this contract, like, so.
I did everything I should have done.
Exactly, I mean, you can't.
I got paid by the title company.
Exactly, right? You can't just say, well, I'm never gonna do this because there's a chance they'll use drug money.
It'll be up to that person to explain, that's the one that they'll ask.
Yeah.
They should explain.
Yeah.
Hey, you got paid cash.
That brings me I had a question for the end, but it's appropriate now. Is this regulated for any federal or state
So
law?
the question was regarding regulations, and there is a regulation where if you do more than 3 owner finance loans a year, then you are supposed to follow a process. That includes the underwriting, the professional underwriting, things like that. If you're under that threshold, there really isn't any
You
regulations.
can do whatever you want.
Yeah.
Interest rates, fees.
Well, okay, so let's go back. Interest rate, there is a maximum interest rate that you can charge for an owner occupant.
Okay.
So, and you'd have to Google what it is today because it's probably gone up, but it's probably somewhere in that 11-ish, 11 to 12. If it's,
4 point.
That's not very good.
no,
Very
but it's based on it's like there's a spread and so there is a max you can charge for interest for owner finance. Owner occupant, I'm sorry. If it's a non-owner occupant, you can charge higher. So most of the rules kind of go out the window. But with owner occupants, there are still rules that we have to follow. Like you can't put prepayment penalties in. So if they're gonna live in the house, they're gonna occupy the house, there's no prepayment penalties. You can't, and the attorney will guide you if you're getting into any like gray area, but you can't make it like a predatory loan.
Yeah.
So you can't set it up, you're hoping they'll fail, so. Yeah, but if it's non-owner occupant or you're lending it to a business, there's a lot less restrictions. You could put a prepayment penalty if they were non-owner occupant. Okay, so let's talk a little bit about terms, that's kind of where the conversation is going. Do you have another question?
No, I said, that's exactly how I had some of my questions on
Okay.
whether you're on the buy side,
Yeah.
sell side.
Okay, so different strategies if you're representing the buyer versus the seller. And so, let's start with the buyer side. Well, what's the interest rate? Well, if I'm buying it, I want the interest rate as low as possible, right? And that could even be, I have seen case studies where people get 0% interest. Right? You think, what? Why would anybody sign up for that? Maybe it's because that the price was, okay, you need this price, I'll give you this price at 2%, 1%, or 0%, or it could actually be tiered. You could do 0% for 2 years, and then 4% for 2 years, and then 6% for the remainder of the term. It is all negotiable. But if you're representing a buyer, you want minimum amount of interest. I've heard some examples recently where sellers are saying, you know what, I'm willing to do 5%. I'm willing to do 5 to 6 because it's a better deal than what you can get, than what the borrowers can get from the banks. And that still gives a good return to the sellers in terms of interest. I mean, it's acceptable to them. Now, is it acceptable to a full-time real estate investor? Probably not. But if the seller is happy with 5% and the buyer is happy with 5%, then that's a win-win.
Might be better off having a higher price, because if something happens and they move and pay you off, your loan balance is higher.
Yes.
You made up on the sale versus the interest rate.
Yep, so the buyer could actually pay a higher price. Like if you run a loan calculator with like the lower price, but they're gonna pay 7.5% interest, you could get the same payment with a higher price at 5% interest. So think about, and the lender is the one that's, if the seller is the lender, they don't have to order an appraisal, right? You can kind of name your terms. The down payment you want as, if you're the buyer, you want to negotiate a smaller down payment. That's better for you. So 10%, 5%, I mean, it all depends on what the seller wants. But I don't usually see 0% down. Seller financing usually requires something down. And then terms for the buyer, 30-year term is going to give the lowest payment. So you could do 15-year term if you want your payment to be higher, but 30-year is going to give that lowest payment. Let's talk about the seller. The seller wants to maximize the interest rate. So, and if the seller is an investor, they're probably gonna want somewhere between that high 9s, 10s, maybe 11, pushing up to like the higher range of what you're allowed to charge. So for me, I charged 9.75. It was 10 when I started. I dropped it during the negotiations to 9.75, and so I'm making 9.75% interest on that money. That 9 to 11% is supposed to be up there. The down payment, like we talked about, 10 to 20%. If you're representing the seller, if I can get 20% down, that's great. I would love that all day. When I listed this listing on the MLS, there weren't as many people that could afford the 20% down. So the home was $220, 20% down would have been about $45,000. And people were coming to me saying, well, we've got 25, but we don't have 45. I said, okay, let's bring it down to 10%. And I'm happy with 10%, 20% is better, but 10 was my minimum threshold. And then term, again, it's all negotiable, but 30 years will give the seller the most interest. So if the seller says that I want to make the most amount of interest, and if you look at the amortization table, in the first 5 years, you'll get the most interest with a 30-year loan. Now you could still put a balloon on there. You could say it's amortized over 30 years, but I want a 5-year, 10-year balloon. That's a complete option. But that's it, and it's all negotiable. Johnny, have you ever done a 20-year amortization or 25?
I did 15, but that was back when home prices were a lot less.
Mm-hmm. And people could afford the payments.
Yeah.
So
And in the 10 years, you're making most, I mean, 10% you double your money in less than 10 years, 7.2 years, so.
Yeah.
So, you know, it's all gravy up front, so.
Yeah, when you look at the amortization table, and we're gonna show an example of that here in a minute, you'll see how high that interest is in those first year of payments, and it's really good for the seller at the 10%.
Emily, I'm sorry, on the last one real quick, did you say when you take a lower down payment that your interest is higher? Or
You could adjust the interest if you wanted. I kept firm, I listed my house a little bit high, and so when I went from 20% to 10%, actually, my negotiation was I went down to 10%, down payment, and I dropped the interest rate by like a quarter point, and that really got it to a point where she could afford it, and she really fit that penalty box buyer profile, and so I wanted her, so.
Says predatory.
No, as the investor and the lender, I want somebody who can afford it, who isn't gonna refi next month. Because when I listed it on the MLS, that was a big lesson learned, because I would get offers, even though it said owner financing only, I would get cash, conventional, FHA, VA offers, and I had to be like, decline, you didn't read, decline. Because they literally didn't read the description or note that it said only, owner will carry. And so the agents would call me and say, well, what are your seller financing terms? And I said, well, you don't understand, like, I already know your clients can these particular people can get a traditional mortgage, because you just sent me their pre-qualification. So I'm not going to lend to them seller finance, because I know they can refi out tomorrow. And that would get rid of the whole purpose of me owner financing. Like, I don't want the buyer that can refinance tomorrow. And so agents would just talk too much, right? They get on the phone and they're like, well, my seller will do or my buyer will do your owner financing. I'm like, no. Like, I'm not accepting them. Like, you don't get it, so. But you do have to educate. Not very many agents are educated about seller financing, so it does take some education, especially if, you're trying to introduce it into the conversation.
And then a buyer represented by an agent versus one not. If they're represented by an agent, they're most likely doing their own appraisal, or not even that. If they come directly to you, they're probably not gonna do appraisal, but.
Yeah, I mean, in a traditional transaction, the lender is the one that requires the appraisal. So you don't typically see an appraisal in
But
an
like
owner
if I was
finance.
representing a buyer, like I can tell them, but if they're like, well, I really wanna know if I'm overpaying, they would just,
The buyer has the option to pay for the appraisal themselves
Yeah.
if they wanted.
but it's not typical.
Not typical, no, but I mean, the buyer ends up paying for it through the lender, like in a traditional transaction. So they end up paying for it anyway in a regular transaction, but it's their complete option. Usually it's, when you get a traditional mortgage, it's not an option. So,
Well, the other thing is, as you said, you want the person who is a checkbox issue, is that what you call it?
a penalty box.
A penalty box, so that they're already not gonna be able to go get a mortgage anywhere. So if they really like this home, they go, well, I'm willing to pay that for it. If the appraisal came in 10,000 lower, what are they gonna do? They
Right,
can't go to the bank, they're gonna say, well, I'm wasting my money, let's get to the transaction.
and actually, that brings up a really good point. In a traditional seller financing scenario, when you're selling to a penalty box buyer, the home is at a little bit of a premium, because they can't go get the traditional lending. Now, it's a little bit harder today, we'll pull up the loan calculator, and it's harder today to get that bottom line number to work, so that the payment works for them. So we'll see that in a minute. So quick FAQs before we go to the spreadsheet. Who draws up the loan documents? This can be pretty much, if it's just a regular seller finance loan and there's no underlying lien, any title company attorney could do it. Any real estate attorney could do it. There's Heather Autry with Independence Title, there's Old Republic, any of their teams could draw up these documents. What are the fees involved? We've kind of talked about that throughout the conversation, but whatever fees the lender incurs gets passed on to the borrower. Just like when you get a loan, a traditional loan, the borrower pays all the fees, so recording fees, document preparation fees. You know, if this attorney's gonna charge you $400 to draw up the loan documents, that gets charged to the borrower. And that is all worded in the 1 to 4 family under buyer expenses.
So are the attorney fees, I mean, because typically, of course, you have that in there, but if they're having to write all this up, are they usually gonna be a little bit more, or it's still?
I think they're pretty affordable, like
Okay.
400, yeah. And you,
It kinda got to where if there's a title company involved,
mhm,
it's less.
It's
If
cheaper.
they're not,
yeah,
it's $800 for,
Yeah.
double the.
400, you know, yeah, they may say, like, if we're doing the title, it's only 400, if we're not doing the title, it's 800. For you as the lender, it all gets passed through, but it is still nice to know, because one of the questions I kept getting asked when I had the listing was like, well, what are the expected expenses? So if you had an estimate of that up front, you could just get a quote from them. Where do I find owner finance buyers? So there are some real estate agents out there that specialize in them. There are Facebook groups that specialize, that target traditional owner finance buyers. If you have a listing, text me and I'll send you, her name's Susie Martinez. She's not with our office, but she has a whole Rolodex of owner finance buyers, like that's what she works with. And so she's actually the one who brought me the client on my last deal. Johnny, you know, you just have to start putting the word out, right? And whether it's on Facebook, whether it's on a sign in the front yard, Craigslist, like.
You kinda get repeat calls after a while. If you do it for one person, it seems like they'll reach out, they know somebody that
Yep.
needs the same thing.
And we did a sign in the yard and we used a Google Voice number. And I would get a lot of Spanish inquiries and I used Google Translate a lot to reply to them on Google Voice, right? You copy and paste from Google Translate. And so if that, like, it kind of going back to Michael's question, like if somebody came to me and they wanted to move forward with a transaction, but I can't speak Spanish, that would probably be a good example of when I would bring somebody in to kind of help facilitate or work with a title company that was bilingual kind of thing. And then how do I know how much to price the home for? We kind of talked about that. So where I want to go, and I know I'm running along on time, I want to talk about the owner finance loan calculator because I think this is going to help answer that question. Because you do want to be sensitive that the payment can't be too high, can't be unaffordable, but it's going to be higher than if they could get a traditional mortgage. So that will kind of help you see, you can click this here, we'll also have the thing at the end. Let's go through the different sections of it. And there's 3 main sections. The first section is in pink, and it's where you enter the loan terms of the owner finance loan. So you have to subtract out the down payment. So in this case, this was a $220,000 home with a $20,000 down payment, so my loan amount's $200,000. Interest rate of 10%. Let's see if I can do this.
Can you plug and play with that when you set up on the drive?
You should be able to, yeah.
Okay.
So 10% interest for 30 years comes out to a payment of $1,755. You see right here, $1,755. Now that number comes over into the green section, the buyer's estimated total payment, because this is what the buyers are gonna care about. $1,755 is their P&I, and then you put in how much you think they'll pay for taxes and insurance. So you can go to the tax, you can see what taxes were last year. In this case, they were $280 a month. Put in an insurance estimate. I put in the loan servicer fee here. And so the total payment for the buyer, the borrower, in this case would be $2,160. That's the number that they care about. That's the number they're gonna ask you about. And that's actually pretty good, right? That's not that high. That's not too bad. I ran another scenario yesterday where the payment was gonna be $3,700. And so you're like, that's getting a little bit higher. So this is the number, when you start saying like, well, how much should I price it for? Like run through some scenarios on the calculator. and then the seller's cash flow is down here at the bottom. So if you don't have an underlying lien, you would leave this blank, this yellow one blank. If you, like, in this case, this particular person I was helping had an underlying lien at $616 a month. And so for the seller would net almost $1,140 every month. So use this, let me know if you have any questions. I know we are getting to, we're over time.
If,
Go ahead.
sorry, if you didn't have the calculator, would you be able to say like 5% above market value or not really?
Yeah, I don't know if I would go full 10%, so I would start with 5. Yeah.
Depending on the price of the home.
Yeah. And then this is a case study. I'll send everybody a slide, so I respect your time. If you have to leave, feel free to leave. I'll send you all the slides here. This was the home that I sold, $20,000 down, 9.75% for 30 years. I owned it since 2016, so I did have that underlying loan. And I want to show you the difference between if I would have kept it as a rental versus me selling it as owner financing. And as a rental, I would have made $1,200 a month, $1,270. As the lender, I'm actually making $1,713 a month. So I'm making almost $500 more per month. And then this goes back to the comment that we made about interest. In the next 5 years, I'll make over $100,000 in interest. Now that's at the 9.75% interest rate. If you talk about 5%, it's gonna be less. But that amortization schedule on the loan calculator will show you the cumulative interest that the lender would make after X number of years.
10% ought to be pretty easy to get for a penalty box buyer today.
Yeah.
Because, they're looking, they're pushing if their credit's even dinged up a little bit.
Right. So feel free to contact me if you have any questions. This is all the resources from today. The owner finance loan calculator, a blank seller financing addendum, and the slides. And so I know every transaction is a little different, every buyer situation, every seller situation is a little different. So if you ever feel like you wanna call me and talk through it, just text me and let's get on the phone. So, thank you all very much.
Thank you.
Thank you.